Good morning, everyone, and welcome to the Investing Conference. This event is brought to you by TimingResearch and TradeOutLoud. The event is being recorded, and all the recordings will be available as soon as they're processed on the TimingResearch.com website. David Kosmeter and I, Ankmet Kaf, will be your host today. So before we begin, let us remind you that all information provided today is for educational purpose only. It should not be construed as investment advice regarding the purchase or sale of securities, options, futures, forex, or any instrument of any kind. Trading involves a high level of risk and may not be suitable for all investors because you could lose money. So before deciding to trade, you should carefully consider your objectives, level of experience, and risk appetite. Individual performance depends upon each person's skill, time commitment, and effort. Results may not be typical, and individual results will vary. You must do your own research and make your own trading decisions. With us today, we have again another fantastic lineup of pro traders that are really happy to share their strategies, tips, and tricks with you from the investing field. So with us today to kick off the event, we have Brian Miller. Brian, you have the mic.
All right. Thank you. Thank you, Anka. I appreciate the introduction. Welcome, everyone. I appreciate the opportunity to be here this morning. My name is Brian Miller. I'm the head strategist or head researcher for equity sciences and optimized trading. Before I get started, let me go ahead and read our quick disclaimer. Historical performance, whether live or simulated, may not be indicative of future results. Trading stocks, ETFs, futures, or FX involves significant risks that may not be suitable for every investor. Investors should only choose to invest funds they can afford to lose without negatively impacting lifestyle. Price characteristics are not predictable or repetitive. Thus, any strategy developed from historical data will be equally unpredictable. We do not guarantee nor claim our strategies will perform positively and or reflect historical results. In fact, there can be significant differences between historical and live results. Please consult your investment professional before choosing a trading or investing strategy to ensure to meet your investment objectives and risk tolerances. All results shown are historically simulated, not live real. All information and data presented is my personal opinion, as I am not an investment advisor. Thus do not consider investment advice nor a solicitation of any individual product, service, and or equity. All right, so now that we got that kicked off, so our firm primarily focuses on quantitative models, which is just a fancy word for systematic models or algorithmic trading structures. And so when we first started optimized trading in equity sciences, we stepped back and we looked at the quantitative world and quantitative strategies, quantitative firms, and more importantly, how they fail. And what is the primary mechanism of failure for what are the primary risks for any trading strategy, to be honest with you? And our research really leaned heavily towards pointing at outcome was too heavily dependent on anything of a single nature, right? Any perspective of a singularity, essentially, right? So not allowing or not finding a way to integrate the benefits of diversification on a per strategy outcome basis, right? And so while diversification is probably one of the main commonalities shared between all firms, no matter if it's trending, buy and hold, it doesn't matter. They all deploy diversification, obviously, for to help outcome consistency, reduce your risk profile, etc. However, not many deploy diversification intra-strategy or intra-asset outcome basis, right? So they might design a strategy or a source of alpha for that model, and then they simulate it. They see that it trades well over a certain amount of time, and then they deploy it live. Well, outcome is dependent essentially on just that single source of alpha, and in some instances, it can be extremely nuanced. And so we don't follow that philosophy here. So we don't pursue extremely nuanced sources of alpha, and the reason for that is those can be extremely environment dependent. And as we know, our environment is in a constant state of change. And so it doesn't take much for that alpha to become out of sync with the market. And so instead, what we do is we try to look at every strategy kind of from a holistic approach, using creatively simple strategic concepts. So we don't use machine learning to source alpha. And the reason for that is so we can know what the underlying, so we can know what the strategy is trying to achieve, what it's trying to exploit. And because when you use machine learning, sometimes you don't fully grasp why the AI or ML algorithm is choosing a certain variant to deploy. So the conceptual risk can be a little difficult to grasp sometimes. And so what we do instead is we design, creatively simple strategic concepts that seek to exploit, the underlying fundamental and behavioral justifications of a market, the underlying biases of that market. But we wrap that kind of creative, simple structure within more complex systematic structures, right? So we can benefit from complexity in a way that doesn't impede the beauty of simplicity, right? Especially if you follow like John Conway's works on rules and complexities. So creatively simple strategic concepts, more complex systematic structures. And what I mean by that is, well, we may allow for multiple entry. As you can see, we allow for multiple entries, and each one of those entries is its own source. It's adaptive. It's looking at the market to see what the optimal entry price or target is there historically. And so one method that we use essentially is called market classification, and it's used heavily throughout all of our designs. And let me switch my screen. Okay, there we go. All right, so essentially what classification is now we don't use any of these analytics, but this is just a very generic example. Classification is essentially every strategy, no matter what what type it is that you deploy. Essentially, that's what you're doing. You're classifying the market into a repetitive condition, right? Whether it's these forms of analytics, those forms of analytics, these fundamental guidelines that you have, no matter what forms of criteria that you're using, that's what you're doing essentially. No matter if it's a value concept, a momentum concept, you're looking for something that is of a repetitive nature that offers a predictable outcome, right? And you look at that, you classify it, and you say, okay, well, that's a strategy, okay? So we kind of look at it slightly differently. And so instead, what we'll do is we look at, 64 repetitive market environments and substructures, right? Because some are more dominant than others. And so these very simple conditions output essentially a true and false. And when you use 6 of those, essentially, because you break that down to binary, right, that equals 64 classifications. All right. And so we also look at that. We want to apply different analytics because we want to tap into the market and analyze it from different perspectives. It's not just good enough to know is something increasing or decreasing or greater than or less than, but where you are in that cycle, right? Is something increasing, but is it overbought, right? Or is it decreasing or oversold, right? And so we prefer to look at or statements. Like I've only inputted 2 there, condition 5 and 6, but typically we use a few more than that. And so we look at, not only is a value increasing or decreasing, but again, if that form of analytic like volatility, right, is overbought or oversold. So is it, within a certain percentage range? And so we typically just break all our analytics down into a ratio output. And so, and this is, you can also be very simple here if you want to be and use analytics that are very common. And so that's what I've essentially shown you just as a generic example. But essentially what we do then is we'll take those classifications and we'll break them down essentially, and it kind of looks like this within the code. And each one of these classifications will have its own entry model, right? Its own entry model, additional entry model, as well as, and depending on how our allocation model is designed, it can also be a market classification specific allocation percentage, because a lot of strategists put a very heavy weight applied to entry and exits, and as they should. It's a very important process. Obviously, it's a very important part of a strategy is your entries. You want your entries to be as efficient as they possibly can. But one area that we feel that it is kind of overlooked is your allocation model, and how much are you allocating on a per entry basis, a per position basis, right? And so that is another area in which we can inject a layer of intellect, and you would be extremely surprised at, even without deploying any logic that tries to identify like optimal entry and exit criteria, logic, price, target pricing, etc. Just with a quality allocation model that uses something very simple like close less than open, or yesterday's low is less than today's low, right? Or today's low is less than yesterday's low. Just with those two very simple entry conditions, with a quality allocation model, you'd be very surprised at the level of consistency that you can achieve. When you're allowing a certain systematic structure to be deployed. Again, whenever you're allowing multiple entries, and the allocation model can truly be dynamic in where it's choosing to be strategic, and how, because some positions, as you can see from the chart here, may see, wow, well, that's this entry here, you kind of had a large drawdown there. Well, it doesn't look that efficient, but the allocation for that entry could be 1% or 2%, whereas the allocation for these entries down here are 10% or 12%, or of a higher value, right? And so allocation is a critical ingredient. It's kind of like, your entry and exit criteria is like the engine and the transmission, but your allocation model is your steering, your steering wheel. And so everything is designed to work in unison to nurture positive outcome, right? And so, and one additional way that we seek to accomplish that is, with your exit logic. And so we have a very robust amount of exits from, intra-bar exits, like market position equals 0, essentially meaning like the bar that executed the entry. We have intra-bar first bar exits, positional base, like it'll exit the entire position, and then a per entry base. And a per entry base is critical to mitigate your risk during systemic risk environments, and also to secure closed return. And what I mean by that is, okay, let's say that this position up here is in a drawdown, obviously, but these entries down here are opening and closing and securing, closing out profitable positions as you're holding an open position drawdown up here, which could still, again, be a smaller allocation than these down here. So it helps overall outcome consistency. It reduces your risk profile. And so our models are designed to, to slightly outperform during strong bull market conditions. However, significantly outperform in, in systemic risk environments, and high volatility and reverting consolidation, cyclical value type of market conditions. And so, which helps reduce, correlation, obviously. But yeah, so, and that's another thing too, is our allocation model is MFE, so multifactorial value. So as value increases, so does the allocation, right? And so multiple entry, or allowing per entry based exits, help achieve a more consistent rate of outcome, and also mitigating your risk profile. And so, for instance, our models, again, are designed to outperform more so in volatility environments and slightly in bull conditions. However, they achieve that with just being in the market approximately 50 to 55% of the time. And your average position allocation, let's say, for instance, you just started trading one of these models, and you started with 100K. This is just as a generic example. It's just a round figure that I use for testing, but you can go smaller than that, obviously. But that is the average position allocation is only between 30 to 40%. So even if you have 100K, the average position sizing there for the entire position would be, because a lot of times your entry, as you can see over here, will just be in and out. So and that's another thing, how we test these is we want the initial entry to be as efficient as we possibly can. So we don't want to rely on additional entries or an intelligent allocation model. So everything is tested in such a way to where we use absolute basic exit logic, no additional entries allowed, set allocation, just to test the initial entry, because we want that to be as efficient as we possibly can on a per classification basis. And then once we found the most efficient initial entry, then we go to the next phase, which is testing the additional entry logic, and then the allocation logic, then the exit logic, right? Positional, then per entry basis. So it's a very thorough testing process, and we try to do it in such a way that understands the risks that are associated with quantitative models, the impact of randomness can have on any strategy, no matter if it's discretionary, quantitative, systematic, it doesn't matter. And so everything that we seek to integrate into the model is designed for mitigating some of those risks, and to achieve a higher level of outcome consistency. And so I understand that the chart here looks extremely busy, and that's also by design, and because we really like high trade frequency. And the reason for that is because we like compounding. So high trade frequency allows you to be in and out you don't have to seek a large percent return on a per position basis to generate to generate alpha, to generate significant alpha. You can be in and out kind of quickly, and then integrate a form of compounding that will that will allow you to outperform seeking large positions, but with a smaller risk profile. And so also trade frequency increases the data points when you're testing, right? So the more trade frequency that you have, obviously it helps to reduce the risks of overfitting. And so we really like high trade frequency in every market environment. And so now when we're testing through the market classification, not every classification is going to be traded, or we might the testing process might organically force it out from being traded, like because the level of value that we're seeking there is so great that it would probably never happen, right? So it's showing that historically. So some conditions are more dominant than others. Some conditions last for 3 months, 4 months, and whereas some conditions and occur less frequently, whereas some conditions, substructures is what we call them, may only last a day, 2 days, 3 days, something like that, but they occur more frequently. And so we, we seek to trade them all as long as they offer a good payoff matrix historically. And so an example, of this, again, historically simulated, but that is using a compounding allocation. This started with 100K. Again, that's just a round figure that I use for testing. You can use a smaller amount. The amount of data goes back to 93, but it only started trading because I use kind of like a large bars back number. So it started trading in 96. So April of 96. So over that period, it essentially took 100K, and out of that, approximately 2.4 million, over those 20 some years, to generate that amount of return from 100K investment. And so there's some of the additional data metrics. And as far as the drawdowns are concerned, how this is kind of, because you're deploying compounding, your most recent drawdown is usually going to be your largest. And the reason for that is because you're deploying compounding, you're trading with more money, you're trading with more, you're taking the profit, you're folding it back in, you're folding it back in. Okay, and so like this drawdown here is going to be larger than, a drawdown down here because you're trading with more capital up here. So that's one thing to be kind of just understand, is your most recent drawdowns are always typically going to be your largest. And that's simply because you're trading with more capital. And so you can see here that, the model is trading in a wide variance of market conditions, all of which are, all the initial entry, additional entry, and the allocation logic is extremely adaptable, dependent on what the condition is, whether it's overbought, oversold, in the meat of an up move, in the meat of a down move, whatever that might be. So again, we break that down to 64 different layers. So we have 64 different values that we can deploy, and they're all designed essentially to work together to achieve a certain type of outcome. And so that is in 2003. Here is the market crash. You can see that now this is a long only model, and you can see, there's still a way to generate a positive return even in bearish conditions by going long. You just have to be strategic with when you go long and how much you're going long with, right? And you can see here from the chart that the rate of growth here really increased in that period, because volatility, we really like volatility, because the models tend to do pretty well in volatile conditions. So again, there's just more opportunity there to be exploited. And so this amount per year, that's what the year to date is up. And so now if you would trade that, if you just started with like, a set amount at the beginning of the year, which I have a client that actually did that. And so the model without compounding, or I'm sorry, with compounding, but if you just started at the beginning of the year, so it's kind of more like an apples to apples comparison, it would be up just a little bit over 4% at this point. So be probably about 4.2% by this point, compared to the market's down, approximately 20%. So there's, a little over 24% alpha year to date, right? Which, obviously 4% isn't that significant. But when you look at it in comparison to what the market is doing, it's very significant, especially when compared apples to apples to, traditionalists, products like buy and hold, right? And so that's really what these products are designed to be compared against. They're not intraday super active trading. right? They are swing trading products. Positions can enter and exit intraday. It can happen. It does happen. But it's not super frequent, right? So the average position hold here is, you're looking from 1 to 10 days, and some positions can exit, or some entries can exit while still holding, maybe another first or second entry, etc. And so here is the here's an example of that. So this is the COVID crash, and so you have intraday exits there, essentially, right? And so this particular model has, at this point, from OOS, which is out of sample, we're approaching, gosh, it's been some time, approximately 42 months or so of OOS at this point. And we pursue very similar concepts, very, very similar philosophies applied across the board, no matter which market it is. Now, that's another thing, is every market environment, or every market, has its own set of characteristics. So we don't deploy like a trending philosophy here, where we say, okay, we've developed this strategy and we're going to push it out on every market. We're going to trade that strategy on every market. And in essence, you're trading the strategy and not the market. You're betting on that strategy, and not really the character, and not aligning it with the characteristics of each asset independently, right? So you're saying, well, this strategy works no matter what market. Well, to me, that isn't very logical. And the reason for that is because some markets have a fundamental and behavioral justification as to why they have different characteristics, right? So the SPY is going to have more reverting characteristics than NASDAQ. And the reason for that is because the NASDAQ is a technology-driven sector and the SPY is more diversified. So diversification equals, essentially more reverting characteristics. That's the reason why more equity ETFs, indexes, and sector ETFs have more reverting characteristics than an individual stock, right? And that's because the stock is more momentum, because there's nothing there other than the market itself to cause the reverting characteristics, right? And so that's the reason why you see, if you do reverting or momentum characteristic studies, you'll see that ETFs on the majority of time. Now, there are some exceptions, and one of the exception is AT&T. AT&T is one of the most reverting. Our models tend to work very well on AT&T, actually. And the reason for that is because they offer such a high dividend that it creates a very high reverting characteristic, even in systemic risk environments. But so, essentially, you have the primary structure, which is market classification, and we're seeking to diversify the levels of value that we're wanting to exploit. And why that is, let me show you just a very generic, you'll kind of laugh at this, but I just put this together. And so it's a very generic, collection of value-based indicators, right? And so the reason for that is value is subjective, just like trend, just like, any other form of analytic. There's a lot of subjectivity in where value is, because of quote unquote value is very different if you're trading a 15-minute bar than if you're trading a daily bar, right? If you're an intraday trader compared to a swing trader. So or if you are a retail trader, or if you're a bank, or if you're an institution, right? So value is very subjective, and it's layered, okay? And so we break things down in a layered approach, and at any point in time, there's more than one layer of value, right? That's within the market. And when I say value, I mean essentially like technical value, right? I'm going to drive some fundamentalists crazy by saying value here, but yeah. So there's layers to that, and we base that off of what current market condition, what the market's currently telling us, how we classify it as to what types of value, what levels of value those are, right? And so that determines what our initial entry is going to be, what our additional entries are going to be, and also what's our allocation percentage, and what type of profitability are we going to seek, not just on a per position basis, but also on a per entry basis, right? And so, all right. So let me show you a couple different markets, and these are slightly different concepts than the SPY, right? These have a stop loss applied to it. The SPY does not. And the reason for that is I initially designed these to be a little bit more versatile of a product, meaning that you could trade it on the CME offers a sector index future contracts now. So I designed this to be traded both on the CME futures contracts as well as the ETF equities, right? So it's a more versatile product. It could go either way. So you could trade it on the futures, or you could trade it on equity markets. And so this is XLU. And so essentially, we're putting packages together that will be offered as a streaming service for both primary indexes. So you have like SPY, QQQ, IWM, MDY, DIA. So you have the mid cap Dow Jones, QQQ, SPY, the Russell 2000. So you have that package. And then on the other package will be the sectors. So you have XLP, XLY, XLI, XLK, XLU, XLB, communications, healthcare. So, there'll be probably 8 or 9 sectors in the sector package. So we're going to offer or you can do both packages, and those will be streamed. So we will be streaming these. So we'll have on one workspace, we'll have 5 charts, and the other workspace will have 8 charts, and those will be streamed. And so we'll also have a signal service, but you can also log in and watch the stream. And so you can see that the trades execute, like if you're a more active type of person. But the good news here is because these are applied to daily bars, the logic essentially updates once a day. So you'll see that. So it's not like something you have to keep, you have to watch every 5 minutes, necessarily. Now there can be intraday targets that are hit, right? Whether if it's an entry or an exit, but those will be shown over on the left side in a blue or red line, whether if there's a limit target or exit target on the chart. And then also within whenever you sign up for streaming and signal service packages, those will be delivered to you via email. And so I'm sure you can set that up to come as a text to your phone as well, to get notification. And so, updates essentially like intra position, like if you're in a position and your dynamic exit logic is going to, those values could update at the close of every day. So for instance, it may start off where you're only going to seek, maybe 25 cents return, but then the bar closes, the classification changes, and now it's showing, hey, we can seek a larger return now for this position because things are moving in a more bullish direction for the position. So it changes, it updates to, $2.30 or whatever that might be. So that logic will just update once a day. So you just check it once a day, and you can change your profit targets and the shares. Now, from a shares it's going to be different than what you see on the screen. So if I go back to SPY, and you're going to see all these dynamic things. So this is kind of like an R&D mode, okay? But when these are actually delivered to the client via stream, so shares are going to be essentially a percentage. So this might be 2 shares, right? So let's just hypothetically, so this executes 2 shares, that would be 2% of whatever you're allocating to that model. If it's if this is 1 share, that would be 1%, and then this is 2 shares, that's 2%. This would be 8 shares, so that's 8%. So it's because everyone's going to be signing up with these streaming packages, applying a plethora of different trading amounts to these in their account, right? So not everybody's going to be the same. And so to kind of simplify that for everyone, and because also we deploy compounding with our models, deploying an interpreted percentage will allow us to continue on without changing things on a quote unquote per units basis or anything like that. So everyone can trade however much that they want to apply to each. That's a discretionary decision per person basis. So you can apply whatever amount you feel comfortable. You can watch it simulate and execute for however long that you want. And so essentially, so that's how the signal will be delivered to you. So it'll be just a number 1 through, I would say no higher than 20 per entry basis. So whatever that number is, however many shares that are executed on that entry is just a percentage for you, right? Super simple, super easy to follow. And so especially now where you can do like fractional shares, that should help be a little bit more efficient. And so, okay, so here's XLU. So this is without compounding, right? And so XLB, again, without compounding. These are slightly different. These are with stop losses. These are just some general examples of the models. It's going to be a good mix. Eventually, we'll offer both. We'll offer models that look more closely like SPY, that don't have stop losses, and then also options that will have more stop losses. So here is XLB, which is materials, and this is a compounding variant. So you can see, and all models, I use 100K just starting out for every model, and that's just a good round number for everything, but obviously you can go lower than that. And so that model is up on the year. Okay, and that's XLK compounding, and that's slightly down for the year. The last 12 months, though, it's still up. And that's healthcare. And there's XLI. So that one's up on the year too, right? So even though that some of these are different from each other, they all deploy a similar approach, and at least that they're trying to exploit some type of value. Now, again, these two structures between, like XLU, these sectors here, these are a different structure than SPY. Okay. And so we're going to have a healthy mix of those. And eventually we'll have 2 completely different packages where you can go in either direction, where you can have less trade frequency and stop losses, or more trade frequency and no stop losses, right? Essentially on a per model basis. So you'll have some options there. And so we seek to be launching those products realistically, probably about the 2nd week of August. And so, we will be streaming that out. A really cool service that that Patreon offers now that allows you to stream out to multiple platforms. So we'll be streaming out to like Facebook and Twitch. We're going to also see if you can do a direct website login and stream it on our website. So, you'll have multiple platforms. Like if you sign up for our service, you're going to have multiple platforms to view the stream from, and then also the signals will be delivered to you via email as well. So we're kind of hitting both targets there, because some people aren't sitting, aren't able to watch a stream. But the good news there is, we're not, even for those that are more active or less active, our models again are applied to a daily bar. So the logic updates are essentially once a day. So, you don't have to watch the stream all day to be able to update it, to update your orders, etc. if you're following it on a discretionary basis. So super easy to follow, very basic, from an entry and exit perspective. And while our concepts might sound complex, the underlying, strategic concepts are just creatively simple. Now we deploy more complex, like overlapping structures, but that's to ensure that our models can be adaptive and not, throwing a stone into the river and expecting it to mimic the flow, right? We want our models to have a good flow to them, to be able to dynamically identify, hey, yeah, it's best to exploit random or reverting type of value in this condition. Or hey, it's best to exploit oversold type of value in that condition, right? And to be able to adapt to that. And for our outcome to not be dependent on a single entry, right? And you have multiple arrows in your quiver, so to speak, right? And so they all work together. All these structures work together to nurture a higher rate of outcome consistency. And to also increase and diversify the number of market conditions that will generate a positive outcome. So our model's outcome isn't dependent on linear growth, right? The market can just go straight sideways, and that would be fantastic for our model. Or it can go down at a certain rate. Now, obviously, there's not every condition is profitable, but when you deploy classification and allow multiple entries and an intelligent allocation module, there's a very wide array of conditions that occur that does, right? And it's a pretty healthy number of percentages. So, obviously that's what we're looking for. And one key factor is reducing the time between new equity highs. And so we want that to be as small as value as possible, right? So that means essentially, we don't want a model to have, a 2-year or a 3-year period between new equity highs, right? We want that to be, 6 months or less, 9 months or less with a daily model. Right now, you're going to have losing trades. You're going to have drawdowns. That's unavoidable. It doesn't matter how intelligent, how adaptive, how robust. It doesn't matter. And so, but the best thing that we can do is try to mitigate those as much as we possibly can. And how we do that is, deploying intelligent exit logic that's on a per entry basis, a per position basis. And again, just being as adaptive as we possibly can with our logic. And so, but that's pretty much it. That's all I have. If you have any questions, please reach out to Robert at Optimized Trading or Brian at Optimized Trading. You can visit our website. Let's see. You can visit our website, which is equitysciences.com. You can contact us there and read more about what we have, from a product and service perspective. We'll also have some products that you can purchase outright coming soon, but most of our services will be on a service basis or solutions basis. So it'll be more like a leasing service where we offer signal services, a streaming service, or those can be to get put together into a single package. And so we'll have an index package, again, which will have SPY, QQQ, in mid cap, Dow Jones, Russell, and then also we'll have the sector ETFs, right, which will have between 8, 9 sector ETFs, and mainly spiders, right? There might be one market that we include that won't be a spider sector, and I think that might be communications. And the reason for that is communications, the amount of data doesn't go back. So there's Vox, I believe, has more data. And data is great. That's another thing too, is whenever we're designing our models, we use as much data as we possibly can. So we go back as far as we possibly can to include the 2000 to 2003, bearish bearish market. We include the 2007 to 2009 crash. So we want as many conditions as possible, as much data as we possibly can, and that'll only help our models to be a little bit more familiar with those conditions in the future should they occur. Never in the same sequence, but you do have some repetitive similar characteristics that can be extracted from that, which the model reads, right? And so again, about the classification, how it works is at any point in time, it's going to fit into one of those 64 classifications. And because of that, we tend to look at volatility very, very closely, because our models are again designed to exploit variations of value such as random, reverting, cyclic, consolidation, oversold, etc. And so we want to look closely at that. But again, if you have any questions, feel free to reach out. We have an open door, an open door policy. If you have any questions at any time, feel free to reach out to Rob or myself. If you're interested in any other content, you can YouTube search Brian Miller Trader, and there'll be some other podcasts that'll come up, and some other presentations with David as well. Or you can check me out on LinkedIn. I've written several articles that you can also read if you have time. If you feel like diving into the weeds a little bit, that's fine. You can talk to me. If you don't want to dive, if you're not the type that wants to dive into the weeds, you can speak to my business partner, Rob. And so I appreciate the opportunity to speak with you this morning. And if you guys have any questions, feel free to reach out. And that'll be all for today. Enjoy your day. Cheers.